so there's a run on BlackRock now that's happening, right? Only on one fund. So it's not the end of the world, but now the identity that they have is being cracked.
And everybody, I'm here with the Economic Ninja today. I've been hearing a lot about this Clarity Act scenario out there. It hasn't passed in the Senate yet, and it's a bipartisan thing, which I love hearing that we're actually getting along with something finally, but there's been a lot of delays. So what's your take on the Clarity Act in terms of what's it mean for XRP holders and just, cryptocurrency investors in general?
XRP holders. Okay. Well, first off, there's not a lot of clarity, right? Because you'd think if it was clear, it'd just be cut and dry and out there. The banks are scared to death of this. Okay. If the act passes as it is, we retain the right to gain interest or yield off of stablecoins. This is really the biggest sticking point. The reason why is because right now my USDC is yielding like 5 or 6% right now on Coinbase. Yeah. It's fully liquid, and I get interest dumped in there every single day.
It's amazing.
Whereas banks, isn't it like a 30-day period?
It's crazy what the banks make you do to get the 0.01
exactly
8%,
and it's not daily. It's not put in there daily. I'm pretty sure there may be some banks are out there doing it. Well, what would happen if all of a sudden people figured this out? Wait a minute, I could get more than a normal savings account, fully liquid.
Yep.
It's insured, right? Which the FDIC is giving a little pushback on that, but I think this is happening on purpose. But people would just start putting money on loan with Coinbase and all these places.
How do you predict where we're sitting at right now in the current market? Because I noticed about 6 months ago, you were talking about things, even 10 months ago, that are happening now. What indicators and how do you do that, man? It's almost magical.
No, there's no real secret sauce other than I've been through 3 economic cycles already as an investor and a business owner, and I've studied cycles for a long time, not just the business cycle, but the investment cycle, how human beings interact at different times of financial cycles. And it's just wash, rinse, repeat. And after a while, it becomes very easy to figure out what's going on. I didn't know that I did a bunch of videos about $150 barrel of oil like 3 years ago. And I went back to look at those videos because they were actually titled as $150 barrel of oil. And I said in there, it's probably going to come from a war in the Middle East. And I explained it. And I'm going, holy cow, I wouldn't have seen that. But really, that's not like a crazy prediction, because that is what actually causes the price of oil usually to spike or drop, is supply chain issues. And that's what we're seeing right now. And the greatest supply chain of oil in the world is the Middle East. Yeah. So it was sort of, it's easy in that sense. What's an interesting one that most people don't understand, because people like to laugh or joke around or comment, how's that real estate crash coming? And what's crazy is that I went back, and my editor is actually editing videos today of when I called the top of the housing market in July of 2022. And if you go look at the Federal Reserve's median sales home price sold, their chart, the top actually came in Q4 of 2022, and that's based off of numbers from Q3. Because it always it's the data that comes in that is now that data, right? So I called the exact peak, and if you look on a percentage basis, we're already about a little over 1/3 of the way of nationwide homes price declines as we saw during the Great Recession. But yet people don't see that because all they see is headlines talking about the median home price that is focusing on the lowest price homes in the nation. And what they're not focusing on is the data sets that are the most important. And that is home sales are collapsing. Inventory is increasing. On a percentage basis, foreclosures are going up at a faster clip than when they went up in mid to late 2006.
Right now, as we speak.
Right now, yeah. Wow. And so they go, it's still nothing compared to the Great Recession. Well, that was the aftermath that everybody remembers. People don't remember the run-ups to crashes. Today, as we're filming this, I always talk about the everything crash, how gold and silver can crash when the stock market goes down. And everyone mocks and laughs, and they have no concept of how capital and equity markets work and how they work in conjunction with each other. And today, the Dow was down like 400 points, which is like nothing. It's 0.6%, right? What's
Okay.
silver down? 10%.
Yeah, I was looking at that chart a little bit earlier. It was dumping off the table right now. It's interesting.
Bitcoin down what, 3.5%, 4%.
It's moving down.
So everything is the stock market going up or down is an accelerator. It's like putting gasoline on fire to anything outside of that. Everything
any
correlates.
other asset classes.
Exactly.
Okay.
Yeah.
Okay.
And so, I'm 70% in cash. I liquidated 50% of my mining stock portfolio in the last couple of weeks. I wish I could have done more, but I've been really busy in life. And so I'm about 70% in cash. I'm pretty much darn near what Buffett's at. Wow. And it's tough on days like when you saw last week a rally in Bitcoin going from like 68 to 74. But I still have to hold strong to my trading thesis and convictions to be able to keep all of that, together, even when things pop inside of a trading range, to know that the long-term aspect or outlook is down.
And thank you very much, because you did mention that you were going to cash, a couple months ago.
Yeah.
And so I did personally get into my portfolios, and any position I had that was green, I went to cash on it.
Nice.
And it was uncomfortable.
It is.
Because the gains weren't where I wanted them to be yet, but at least we were still somewhat. And I'm so happy that happened. I'm not 70%, which thank you for sharing that. That's very personal. Hey, going back to like 2015 or 2017, can you kind of, maybe help some of the viewers? Give us your journey in terms of maybe one thing that you wish you would have learned earlier on your process.
Yeah, it's great. Yeah. So let's talk about 2015. 2015, we were supposed to see a recession. All right. Yeah. And it didn't happen. And this is why. So the Federal Reserve has this amazing playbook that nobody really pays attention to. And what they do is they build markets and crash markets based off of interest rate policy. Wow. And in 2014, 2015, if you go look at the federal funds rate, you'll start to see it stair stepping up pretty aggressively, I might add. Compared to what they did in like 2004 to 2006. But they did an immediate about face and slammed rates down. And the reason why was in 2016, Trump became president, right? And they had been slowly stair-stepping up, but at a pretty good clip, interest rates to get ready for the next crash, to cause the next crash. Because anytime interest rates go from low to more expensive, and on a percentage basis, you have to realize, even though we've been at near zero for a long time, like 15 years, 20 years, it gets worse. The percentages get worse. So let's say interest rates are at 5% and they raise it to 7.5%. Well, that's an increase of about 50%, right?
Okay.
In rates.
In rate percentage, yeah.
But can you imagine if rates were at 1% and then they increase it to 2%?
Wow.
Well, that's 100%, right? Well, what people don't realize is even though they're historically low, people get, it's like the size of a fish in an aquarium, right? They say the fish always grows about the size of the tank, right? Very seldomly do they grow past the size and they're too big. Well, humans do that with their monthly budgets. So based off of how much they make, if they get a raise, they find another way of getting a payment. And it's just the way humans are created, especially in a debt-ridden society. And so what happens is when the Federal Reserve raises those rates, it becomes very uncomfortable. They do it so slow that it's that frog in the boiling pot of water. Well, in 2015, when they were raising rates, Trump came in and said, hey, the Federal Reserve's trying to crash the system. And they did an immediate about face and they dropped rates.
I remember that.
We were right on the verge of a recession. And because they dropped rates, it spurred borrowing and it sort of disappeared. Another thing that's been going on is that since the Great Recession, we haven't had that hyperinflation that everyone talks about because they could, after the Great Recession, they started printing money like you wouldn't believe, right?
Yeah.
They really haven't stopped that. There's been waves, but if you look at the amount of money created during COVID and now just recently, the amount of money being created through the Federal Reserve repo facility to keep the banks liquid and funded, there's a ton more money. Well, the reason why we never had hyperinflation in the Great Recession after that during QE and why we haven't seen that during like COVID times and stuff is because the velocity of all that money being created doesn't exist. The Federal Reserve gets the government to borrow money, right? And they do it at interest. And then those bonds and treasuries essentially go get parked somewhere and they don't move. If that money that was created was in the people's hands, you would see something much worse than what happened during COVID when everybody was handed stimulus checks and everyone ran out to go build a new fence.
Much worse?
Much worse, because think about just the amount of money, the very little bit of money that was created and salted amongst the poor and middle class. They ran out, they bought cars, they built onto their homes. They went and bought new homes. They bought crypto. And what do all those have in common during that time? What did they all do? They went up.
They lifted up.
That's right, because you had too many dollars chasing too few goods.
Thank you. I'm going to keep going, but ladies and gentlemen, I forgot we were recording here for a minute because this wealth of information is mind-blowing to me. Thank you very much.
Well, I never get asked questions, so
this is awesome, man. Because this is historical facts that are on record to bring things economically to this is a deep dive. Thank you.
Yeah.
Okay.
So when going back to the 2009 era, all that stuff had already collapsed. It already been in a stock market had been turning down for 2 years. Mortgage-backed securities were collapsing for 3 years. The Federal Reserve intervenes in January of 2009 and opens up their repo window, to be able to repurchase assets and like short-term loans they provided for banks. Well, now that repo window has been open and wide because the banks are actually crashing now, but you can't see it because they have the ability to get money and stay liquid and solvent overnight, right? Because they put out either too many loans and they don't have enough deposits. That's why you're seeing banks right now like begging for your business, trying to get you to leave another bank for them because they're giving you this for free or that for free, more interest, but on the back end, they're going to charge the crap out of you, right? But what they need more than anything is your deposits, because without those deposits, they can't qualify for more loans under the insane system of being able to loan out 9 times the deposits
from the Fed, right?
As the numbers have changed, they're more than that, but so it's called the fractional reserve system. So now let's draw parallels to what's going on right now. So back then we had the mortgage-backed security crisis, and if you remember, back then it was a big deal because it was so much money, a percentage of our stock market. Well, now you've got credit cards well over $1 trillion, right? They're maxed out. Everyone's maxed out. Car loans are insanely huge, and you have student debt. So all three of those are at all-time highs, which they were at all-time highs back then too. So there's a parallel, right? Okay. Now you add private equity. Well, private credit right now equals $1.8 trillion, okay? Wow. And this is rich people money. So a lot of people watching this might go, well, I'm not rich, so let's watch the rich burn. This is not good for you. It's worse for you than for the rich. What's happening right now, when BlackRock announced that they're going to start limiting withdrawals from one of their private credit funds, that's never happened in history. In history, they've never had to do that. Wow. Then you couple that with JP Morgan coming out, and Jamie Dimon's been on the forefront of saying, hey, where there's one cockroach, there's more. And because he already knows. The things that I've been reporting, I said, it's way bigger than Blue Owl and many other private equity funds. So the contagion starts with the small guys, right? I remember covering this in the banks where we saw about 12 or 13 banks go down when Silicon Valley went down. And I projected that 4 months ahead based off the FTX crash. And I said, we're going to start seeing banks collapsing next year because of the amount of leverage they had tied to FTX. Well, the thing that sucks and what's really scary is private equity is larger than the mortgage-backed fiasco back then, right? Okay. It's now collapsing. It started with Blue Owl, based off of a couple of car parts manufacturers that went bankrupt, and they found out they were cooking the books. And so when you add all that up, and then you start to see that it's now hit BlackRock, right? Yeah. They're now limiting withdrawals because there's a run on BlackRock on one of their funds. Okay, that's what it is.
I didn't know about this.
Yeah,
sorry about we got the pups.
You got the dogs out there looking at other dogs or something like that. Anytime you find out that a fund is limiting withdrawals, you're more than likely not to want to put more money in with them because what if there's contagion? Well, when you add to the idea that now JP Morgan is out there saying, hey, we're now going to charge more for the money that we lend to private credit in this sector because it's so bad, or the insurance cost for this is going to go up because all these banks that put out money, they pull insurance on all of these derivatives, on all of these investments. This is why AIG went down in 2008 because all the insurance that was, you could have one instrument, one investment instrument for $1, but behind it there's an insurance policy, pulled on an insurance policy, pulled on an insurance policy. Those are derivatives. And that's what's about to implode later this year. You're going to see the insurance industry start to crack pretty wide open, actually.
That's awesome, Ninja.
Yeah.
Man, my brain hurts right now. How about, I think all this stuff we have to process and take notes. Ladies and gentlemen, take some notes on this information, but I can't thank you enough, Ninja.
Thanks.
And just the time that we've hung out and the words that you bring to the table.
Yeah.
It's very much appreciated, man.
Yeah, man. Thanks, dude.
So yeah, thanks for coming by.
Yeah.
You've helped me, ladies and gentlemen. The Ninja, when I met you, you're the one that encouraged me to start a YouTube channel.
Yeah.
And it has been very difficult, not easy, but I'm not going to quit until...
But you're enjoying it.
I'm having fun doing it.
Yeah, a lot of people are. And you may be turning this into a full-blown business.
You don't know.
You have the legal right in the eyes of the IRS to turn this into a business and write specific things off that you couldn't do with other things.
Ooh, I like that kind of talk.
Most people don't think about that.
Yeah.
Like, everyone should have a social media presence and everyone should monetize it, and stop looking at the Google ad revenue. And hopefully if people watch this video, you'll probably monetize on this one video alone. Yeah. And it's but aside that, you could do affiliate links, you could do all kinds of things to raise awareness, make money, and help people at the same time, change your life. I mean, there's nothing negative about it other than the amount of hours it takes and dedication.
Yeah, but nothing comes easy, right?
Nothing.
That's awesome, Ninja.
Right
Appreciate
on.
you, man.
Thanks, man.
All right, enjoy the rest of your day, man.
Sweet. See ya.
Awesome.
Thank you.